Nearly 6 years after home prices started falling and $7 trillion in housing value has been wiped out, home prices and sales finally seem to be on the upswing, while demand for mortgages is picking up. According to the latest read on the S&P Shiller Home Price Index, the most closely watched barometer of home prices, 20 major metropolitan areas saw home prices rise by 0.5% in June compared with a year ago. That marks the first year-over-year increase in home prices in nearly 2 years. And if you exclude government tax credits in 2010, the year-over-year increase is the first positive result for the Shiller Index since December 2006. What's more, a separate national index released by Shiller showed home prices rose 1.2% in the second quarter from the same period last year, the largest quarterly gain in home prices since 2005. But to be sure, home prices are still down some 31% from their peak in 2006. Still, housing is finally expected to add to gross domestic product for the first time in 7 years. So has the housing market finally hit bottom? Joining me now is Robert Shiller, co-creator of the S&P Shiller Home Price Index, a professor of economics and finance at Yale, and co-founder and chief economist of Macro Markets. Shiller is probably the only person to have predicted both the stock market bubble of 2000 and the real estate bubble that led up to the subprime mortgage meltdown. He's also the author of numerous books, the most recent being Finance and the Good Society. Professor Shiller, welcome to the program. It is always great to speak with you.
My pleasure, Jennifer.
So we're seeing a lot of positive trending data on the housing front, whether it's prices or sales. Has the housing market finally bottomed?
Yeah, you use the word finally. Well, nothing is final in economics.
That's true.
It'll go up and it'll go down. So the question, I guess, that you were driving at is this the beginning of another boom like the one that we saw over the first, much of the first decade of this millennium? But I think, you know, that was the biggest boom we've ever seen in U.S. history for the country as a whole. So I wouldn't expect anything like that coming right out right now. It might be that it's on the uptrend, but, you know, the Pulsonomics forecasters, this is a group that surveys professional forecasters, they only see something like a 2% home price increase for the next 5 years on average. So it doesn't seem to be that there's an inspiring story out there yet.
Where do you see home prices, say, in the next year and then the next maybe 5 years?
Well, I think in the short run, we're likely to see more increases. We've seen such sharp increases in the last few months, and that will probably persist for some time. But I don't know about the longer run. It's always ambiguous, and the world economy is in such a precarious state now that I don't know. I think housing is still a risky investment.
So how much of the improvement we saw in housing this past spring was organic versus seasonal in your view? Would you expect home prices to ease as we head into the fall months and those traditionally high buying months in the spring and summer are behind us?
Well, we estimated that about half of the price increase in June was due to seasonal factors. This is a strong season. It's a little hard to estimate that, though, because seasonal factors seem to be getting stronger. We don't have a good theory why they are getting stronger. So I don't know. But if you combine the seasonality, yeah, it is true that they'll probably go up for a few more months. I just think that it could go either way. This is not a clear forecast right now. So people who are thinking of investing in homes have to do it with their eyes open.
How much of the trajectory of the housing recovery hinges on the health of the labor market? If we are indeed facing structural unemployment in this country, how does that bode for the housing recovery?
Well, we just had a bad job market report, and so that raises the issue, yeah. People are dropping out of the labor force, too. So I think generally, when a lot of people are thinking, you know, I won't be able to get a job, so I might retire early. But that kind of decision is also a decision that cuts back on the demand for housing. Also, I think people are more into renting now. The whole idea that you have to own a home is receding a little bit. These are reasons why there's still some longer run concern that the market might not just be lively and brilliant in the next few years.
Yeah, on that point of rents, we've certainly seen rents continue to climb as people have shied away from buying houses because of issues like negative equity and falling home prices. Do you think there's been a fundamental change in attitude towards home ownership in this country?
Well, this is something that we hear a lot, that people, on my own questionnaire surveys of home buyers, we did ask a question, do you think people are getting more warm to the idea of renting? And most of our respondents said yes. So I think that there is a switch. That's another reason to think that the housing demand is not secure and not something that's going to necessarily keep going up.
How does consumer confidence tie in with the state of the housing market now? I know you've done a lot of research on this. Do you foresee the so-called animal spirits kicking in at any point here soon and helping to create some sort of a positive feedback loop for housing?
Well, you never know about these things, and we've seen some improvements in confidence. But lately, you know, I think people are getting a little bit worried again. I guess the presidential election might give them some sense of new hope. They hear these brilliant speeches at the convention. Does that brighten their hopes? Not by a whole lot that I can see. So it's still very iffy. And I think we might be in a period of kind of stagnant confidence for some time.
And that might mean stagnant home prices in turn. Is that what I'm hearing from you?
Right. Right.
Okay. Switching gears slightly, I'd like to get your take on the sentiment and psychology surrounding investing in stocks. Individual investors seem to have lost confidence in the stock market, judging by the massive outflows from equity mutual funds. My question is, how much of this is because of high-frequency trading or computer glitches versus just subpar returns over the past 12 years? You know, is the cult of equity dead, as Bill Gross so famously wrote recently?
Well, I have stock market confidence indexes that you can see on my website, and I haven't noticed any really major change. So I don't think, because mine are based on institutional and individual investors. I think that people still believe in the stock market. You know, it's not. If everyone were pulling out, it would be abnormally low now, and it's not low now at all. But by my price-earnings ratio calculations, it's on the high side. People still are in there. They still believe in stocks, and believe it or not, they still believe in housing. Not as much, but somewhat for the long run.
The financial industry has been vilified for its so-called innovation in the securitization market that led to the financial crisis and the ensuing quote-unquote economic malaise. But in your book, Finance and the Good Society, you argue we should harness financial innovation because it does lead to a better society. How so, Professor?
Well, I think it's kind of one of those invisible things, right? You don't know what society would be like if we didn't have all this financial innovation. We see all sorts of amazing things around us, like your new cell phone or whatever, that are the products of a financially driven economy. That we don't, and it seems to me that we have a tendency to think that charity and philanthropy are the ultimate protector of people. But in fact, you know, it's insurance and risk management, financial risk management, that most people depend on, not gifts and charity. So I think we have to see this financial sector continue and to develop. That was the theme of Finance and the Good Society. And in the wake of Occupy Wall Street, what do people do who are upset about some bad things happening in finance? I think a plausible thing for young people to do is to go into finance and fix it from the inside. I don't see any other effective way to deal with the problems.
Well, what about, you say, financial risk management? That's supposedly what J.P. Morgan was doing out of their CIO office in London, and it's caused them a lot of losses. You know, it seems like financial engineering, maybe it's because there's been poor oversight, but helps lead to kind of blowing up the financial system. I mean, what about that? I mean, is that innovation? It's kind of destruction of wealth.
Well, when you take risks, calculated risks, you still lose sometime. So the fact that some company lost a lot of money doesn't really malign the whole concept of risk management. But the big issue now is systemic risk. And I think this is something that we didn't quite foresee and understand. The Dodd-Frank Act has created a Financial Stability Oversight Commission and a new Office of Financial Research. And I think we're getting better at understanding risk and how to deal with it. Systemic risk is really an important problem. That's what we just discovered.
Professor Shiller, thank you so much for coming on the program and sharing your insight. You always bring something interesting to the table. I hope to see you soon.
My pleasure.